All right, today we're going to talk about a financial strategy that's supposed to be a shield for your investments against one of the biggest, most unpredictable forces out there, changing interest rates. It's called portfolio immunization. But, how well does this shield actually work when things get messy? Let's dive in.
So let me ask you a quick question. You buy a safe investment, like a bond, right? And you think you're pretty much in the clear. But what if I told you there's a hidden risk there? Something that could be quietly eating into your returns without you even noticing.
And that's where we start, with this sneaky, hidden risk that's lurking inside the very investments that a lot of people think are rock solid, fixed income bonds. That risk? Well, it's got a name, interest rate risk. You can think of it like financial gravity. It's always there, always exerting a pull on the value of your portfolio, whether you're paying attention to it or not.
The easiest way to picture this is with a seesaw. It's super simple. When new interest rates out there in the market go up, the value of your older bonds, the ones with the lower rates, goes down. I mean, why would anyone want your old bond when they can get a new one that pays more? But on the flip side, if rates fall, suddenly your older bonds with those higher rates look fantastic, and their value goes up. It's this constant up and down that creates all the uncertainty.
So, how on earth do you protect yourself from this wild seesaw ride? Well, this is where our main topic for today comes into play. Portfolio immunization. It's a strategy cooked up specifically to build that financial shield we were talking about. So at its very core, immunization is a technique to just neutralize the impact of those interest rate swings. The goal here isn't to hit a home run and get the highest returns possible. No, it's all about creating stability and predictability. It's about knowing you can meet a specific financial goal down the road. This is why it's so huge for, say, pension funds or insurance companies. They have promises they absolutely have to keep in the future. So how does it actually work? Well, the secret sauce is matching the duration of your bond portfolio with how long you plan to invest. Now, duration sounds technical, but just think of it as a simple measure of how sensitive a bond is to interest rate changes. By lining up your duration with your timeline, you're basically trying to find this perfect balance point. You're trying to make sure that when you need your money, let's say for retirement, the right amount is there no matter which way that interest rate seesaw has tilted in the meantime.
But like any shield, it's not made of adamantium. It's not invincible. And the true test of any financial strategy is what happens when it gets slammed by extreme conditions. So let's go looking for the cracks in this shield. And this gets us to the absolute heart of the matter, the big question from our source material. In the kind of unpredictable world we live in now, with all its economic surprises, just how strong is this immunization shield really? Okay, the first major stress test for this whole strategy is something we've all been talking about: unpredictable inflation. When inflation just goes wild, it forces central banks to act, and those actions can send some serious shockwaves through the bond market.
And the reason this is such a problem is that immunization really relies on a certain amount of predictability. When the Fed has to slam on the brakes and hike interest rates suddenly and aggressively to fight inflation, well, that can just overwhelm the delicate balance of an immunized portfolio. The shield definitely gets dented.
Now for the second big challenge. This one is a little weird, a little more technical, but it's a huge disruptor. It's a market phenomenon called an inverted yield curve.
Okay, so normally you get paid more interest for locking up your money for a longer period of time. Makes sense, right? But with an inverted curve, the whole market gets turned upside down. You actually get a higher interest rate on a short-term bond than a long-term one. This usually means investors are really worried about the near future. And for immunization, this is a real problem because the whole strategy depends on the normal, predictable relationship between short and long-term rates to balance things out. When that relationship flips, the math gets messy and that shield becomes way harder to maintain.
So with all these challenges, it's pretty obvious that this strategy isn't some kind of free lunch. Like any kind of insurance policy, immunization comes with a price. There's always a trade-off you have to be willing to accept.
Our source material asks this question directly, and honestly, it's probably the single most important one for any investor thinking about any strategy. What are you giving up to get this protection?
And the trade-off here is pretty straightforward. The benefit is certainty. You're trying to smooth out the bumps and aim for a predictable result. So what's the cost? Well, you're giving up potential upside. If interest rates happen to drop like a rock, a regular, non-immunized portfolio could shoot up in value. By immunizing, you're basically saying, you know what? I'm going to sit that potential roller coaster out. I'd rather have a much smoother, more predictable ride.
So after looking at how it works, what can break it, and what it costs, what's the bottom line? I think it's just crucial to see portfolio immunization for what it is, a very specific tool for a very specific job, not some kind of magic wand.
Let's wrap this all up with the most important takeaways. First, just remember, this is a defensive strategy. It's about protecting a goal, not about shooting for the moon. Its main purpose, its primary job, is to protect you from interest rate risk. But its effectiveness can definitely be challenged by weird economic conditions, like crazy inflation or those inverted yield curves. And finally, and this is the big one, you're always making a choice. You're trading the chance for higher returns for a lot more safety.
And that leaves us with one final thought. You could look at portfolio immunization as trying to find a perfectly calm harbor to just wait out a storm. But the bigger question for any of us as investors is deciding what kind of journey we're really on. Is the goal to try and avoid every single storm? Or is it to build a ship that's strong enough to weather them, whatever they may be? The answer to that question pretty much defines your entire approach to investing. Thanks for joining me.